Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, June 15, 2010. Today's theme was that of risk appetite, especially in the euro-dollar pair, but first I want to get started in the Asian session with the Bank of Japan. Bank of Japan Governor Shirakawa said that the economic recovery, which so far has been led by higher exports and industrial production, is starting to see some pickup in private domestic demand. The Bank of Japan kept rates at 0.1% as expected, and also unveiled a 3 trillion yen or $33 billion program aimed at encouraging lending to businesses. Bank lending fell 2.1% in May from the same month the year before, the sixth straight drop and the steepest since August 2005, a report had showed earlier this month. However, there seems to be a lack of demand from structural economic weakness, not because there is a lack of liquidity, so it remains to be seen if the new program will spur growth. Newly appointed Prime Minister Naoto Kan is expected to unveil his economic plan along with a roadmap to restore fiscal health before going to the Group of 20 summit later this month. Taking a look at the dollar-yen pair, we see that the yen gained in overnight trading, perhaps as a response to the Greece downgrade news from yesterday, but gave up its gains in New York session on the back of risk appetite. Really, the pair remains confined to about a 120 pip range the last 7 sessions. In the UK, annual inflation fell to 3.4% last month from 3.7% in April. Economists had expected inflation to come in at 3.5%, and the Bank of England would target inflation at 2%. The decline marks what central bank officials will hope is the beginning of a downward trend. Prices rose 0.2% on the month, also less than expected. The BOE expects the economy to have a large margin of spare capacity, which will significantly cool price growth. Cooling inflation would allow the BOE to keep its forecast of keeping monetary policy extremely loose for many months to come in the face of aggressive fiscal tightening, strains in the banking sector, and the weakness of the UK's main trading partner, the Eurozone. The pound-dollar pair slid in the wake of the inflation news, testing the area around 1.47, but as risk appetite took over in the US session, the pair rose to move slightly above its high from yesterday. The pair is in the midst of a rally within a broader upward sloping channel, and currently it may be testing the top part of that resistance of that channel. Turning to Europe, we had two fundamental releases. First, the German ZEW Economic Sentiment Index, a measure of confidence in the German economy from institutional investors and analysts, slid sharply to 28.7 from 45.8 in May. The financial market experts expect the German economic recovery to weaken in the second half of this year because of the uncertainty about the future developments of the debt crisis and the perspective of necessary cuts in public expenditure in EU member countries. Despite the decrease of the economic expectations, the economic outlook still remains positive. Also from the release, the current conditions improved considerably. Here's a look at a chart of the ZEW sentiment, and we can see that it has declined rather sharply in the last few months. In the second release from the Eurozone, the trade surplus of the single currency bloc was at 1.4 billion euros on a seasonally adjusted basis in April. The trade balance was revised to show a flat reading in March. A weak euro and stronger demand in key overseas markets such as the US and China are offsetting strains in trouble spots along Europe's southern fringe. As we can see from the data, both exports and imports declined during the month. That followed rather sharp increases in both figures during the March period. The euro-dollar pair took the weak German ZEW data in stride, and we saw the euro extend its rally that has brought the pair up from a 4-year low near 1.118 back here in June 6th. The pair retraced 50% of its most recent rally from our Friday low to our high yesterday, which also tested the 50-period moving average in a 1-hour time frame, and then following that rose almost 170 pips throughout the New York session. That tested our highs back here on June 1st. The rally was powered by the momentum we are currently seeing in U.S. stock markets as the Dow Jones Index jumped to a triple-digit gain in early New York trading and built on those gains throughout the session. The euro and U.S. stocks reinforced each other as the rise in the euro meant that the worries about the Eurozone sovereign debt may be easing. Still, there are rumors that Spain may be in trouble and may have to dip into the stabilization funds set out for that purpose. However, that news was unable to dent the rally, and we'll see if we are able to move above this resistance level and target the 1.2450 level, our high from May 28th. Turning to U.S. data, the Empire Manufacturing Index for the month of June rose to 19.6 from 19.1. While that missed expectations, it was an improvement and shows an increase in activity in the manufacturing sector in that region. There was steady and firm month-to-month acceleration in both new orders and shipments, and therefore the news was taken as a positive. A second report showed U.S. import prices fell 0.6% in May, reflecting a steep 5% monthly decline in import petroleum prices. The inflation outlook right now in the U.S. is benign and shouldn't stand in the way of policymakers. The rising dollar is a big plus that will keep import prices down and help keep inflation in check. Continuing with our U.S. releases, sovereign debt troubles in Europe have tripped a very significant inflows into long-term U.S. securities, as net long-term TIC flows for the month of April rose by 83 billion on top of March's enormous inflow of 140 billion. Given Europe's troubles during May and the big downdraft in US interest rates that month, this report is likely to show another month of strong inflows for May, which means that foreigners' demand and appetite for US Treasuries remains strong. In a fourth release from the U.S., pessimism among U.S. homebuilders grew in June after a tax break for home buyers expired. The NAHB Homebuilders Index dived to 17 in June from 22 in May, sharply below expectations. Recently, we've seen our commodity currencies rally strongly as we've had a rally in equities and commodity prices. Today, however, the US dollar Canadian dollar, while gaining, was unable to move below its low that we had seen in yesterday's session. We'll see if that means that the 1.0230 level is an important level of support, or if we're able to move below that in the coming sessions. It was a similar story for the Aussie US dollar pair, which after declining in yesterday's trading, rallied to pair all of its losses and was again testing this high from yesterday at the 0.8650 level. So here too, we look to see if we are able to move above that level during the upcoming session. We have seen how the 0.85 level was an important level of resistance, and actually we moved to retest that level as support, so that's a rather positive and bullish sign for the pair. So let's look at our market highlights and key fundamental releases from today. So let's see what the fundamental docket holds for the next trading session. Tonight at 7, the UK will post its nationwide consumer confidence index, which is followed by the Japanese tertiary industry activity index, a measure of the services sector. That is followed by Australian MI leading index, as well as a quarterly look at housing starts. Overnight, the UK posts its claimant count and unemployment rate, a look at the employment picture for the latest month, while the Eurozone posts its final version of its consumer price index for the month of May. In the North American session tomorrow, the US has 3 key releases: producer prices, housing starts and building permits, as well as industrial production data. So that'll do it for today's recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.